Let's break down how to start investing as a teenager. This video will be broken down into 4 different parts. Part 1, style of investing. Without a doubt, the biggest benefit investing at a young age has is time and compound interest. With that being said, the preferred style of investing would be for the long term. Investing in a low fee market-wide ETF such as the VOO or the VTI would provide diversified exposure to the overall market from a reputable fund in Vanguard, which also charges very low fees, and this would allow you to invest in the overall market for the long term. Part 2, compound interest. Investing in VOO or VTI might sound boring, but this tried and true strategy has provided amazing returns in the past over the long term. This is true because of compounding interest. On average, the stock market provides 8 to 10% annual returns. Some years it can be much more than 10%, and some years like this year it can actually be negative. But on average, if you invest for the long term, you can expect around 8 to 10% returns on an annual basis. If we assume 9% annual returns, which is right in the middle of that range, this table will calculate your overall returns when you're at the age of retirement. And as you can see, it's completely possible to be a multi-millionaire by retirement, and this is only made possible because of compound interest. Starting off with a $5,000 initial contribution at the age of 18 and then contributing $6,000 each year will lead you to have an account that's estimated to be at 6.6 million US dollars. Your total contributions during that whole time, which is 50 years, would be $305,000. So $6.3 million would be just returns from compound interest. This shows you how important and how valuable time is when investing. Part 3, investing accounts. There are different types of investment accounts for teenagers. If you're over 18 years of age, you can open up any type of investment account. If you're under 18, you're limited to 3 main options: a custodial Roth IRA, a 529 college savings plan, or a UTMA account. My favorite is a custodial Roth IRA for 5 main reasons. Reason number 1 is that the Roth IRA allows you to pay taxes up front. As a teenager, your taxes are most likely going to be in a low tax bracket. This will then allow you to take your retirement out tax-free, when ideally you'll be in a much higher tax bracket. Reason number 2 is that the Roth IRA is a retirement account. So unlike the UGMA or UTMA account, the money you have in your Roth IRA will not count against you when it comes time to apply for financial aid for college. This is big because I hate to see someone who invested early and had positive returns have that money taken away from them when they apply for college. Reason number 3 is unlike 529 plans, the money in a Roth IRA does not have to be used for educational purposes. Don't get me wrong, a 529 plan is great for a parent to open up for their kids at an early age, but once that person starts making earned income, a Roth IRA is going to be better. Reason number 4 is that Roth IRAs are focused for the long term since they are a retirement account. Therefore, it helps keep the investor invested and allows compound interest to work for you. And reason number 5 is that Roth IRAs will allow distribution or allow you to withdraw money penalty free before retirement for educational expenses, for first-time home buyers, and for qualified medical expenses. Therefore, the money saved in that account, which has grown over time, can be used for those big life moments. It's for those 5 reasons why I favor Roth IRA for investing. Part 4, how to open up a Roth IRA. Before we discuss how to open up a Roth IRA, there are some things you need to know. And I recommend you read more into Roth IRAs before you actually open up the account, just to make sure that it's right for you. But the main things with a Roth IRA is that the money that you invest in the Roth IRA has to be earned income, and the money is meant to be invested in the account until you are at least 59 and a half years old. Earned income is classified as money you make working. The job can be anything. So if you have no earned income, you cannot contribute to your Roth IRA. The good thing, the positive for teenagers, is that if you do have any earned income, money can be gifted into your account, but it cannot exceed $6,000 annually or the amount that you make make as earned income. For example, let's say that you make $2,500 a year working the food stand at your local pool, but you spent all of that money and you have nothing to show for it at the end of the year. Well, you can be gifted $2,500 to put into your investment account and invest that money for the long term. Now, if you're under 18 years old, you're going to have to open up what's called a custodial Roth IRA. These types of accounts are not offered everywhere. Two brokerages that have these types of accounts include Fidelity and Charles Schwab. In a custodial Roth IRA, the custodian, who's likely your parent, is going to manage that account until you're 18 years old, at which point you will then take over that account. If you're over the age of 18, it's still definitely worth opening up a Roth IRA, and most brokerages will offer a Roth IRA for someone who's over 18. I personally use Interactive Brokers, which is highly rated for their Roth IRAs. It got a 5 out of 5 rating from NerdWallet. There's an affiliate link for Interactive Brokers in the bio if you want to check out their stuff. Now that concludes this video. Show some love in the comment section and hit that follow for more investing content. Thank you, and I'll see you on the next video.